Please introduce yourself from where you are attending the session. Mention the name of the bank or organization you are working for. Any first time attendees here? If any of you are attending for the first time, just type FT. FT. So what is our topic today? It is working capital. Working capital. It is basically working capital management. We'll try to talk more on the assessment angle. And since there are quite a few first-time participants, I'll just uh, take a 1-minute introduction. Probably Diamond members would have heard it so many times, but please allow me just to give that 1-minute introduction. Okay. Yeah. So this 1-minute introduction is about me. I am CA N Raja. I'm the speaker. I'm the faculty for the session. You are listening to me. I started my career. See, I'm basically a chartered accountant by qualification, a teacher, trainer, coach by passion. I started my career with State Bank of India. I joined SBI as credit analyst long back. I worked for a period of 4 years, and in very short period, I got elevated as team leader of credit processing cell. And because of that, I had an opportunity to work on loan proposals starting from 10 crore to 500 crore. And in the period of 4 years, I worked on 250 plus projects, which is 5,000 crore plus size. So that's the kind of exposure I was able to get in State Bank of India. Then after 4 years, I came out and started my CA practice. I had my practice for a period of 7.5 years, where I focused on project financing and debt syndication. I also started teaching parallelly during this time. I used to teach financial management and strategic financial management for the students pursuing courses like CA, CMA, CS. Then I developed teaching through courses in online platform or using online technology. And thanks to the technology, today we have 3 lakh plus learners learning banking, credit, finance, accounting, and costing through our online courses. And they are spread across 180 plus countries. And to be very true, I don't even know the name of many of the countries, but we have students across 180 plus countries as per the data I have with me. Okay, so this is my background, and now we are directly jumping into the topic. Okay, so what is our topic today? It is working capital. Working capital. Let me start with a small story or a small scenario. Small scenario. Probably whoever have attended today's term loan session, there will be some close resemblance to that. Okay. Now imagine you are starting a business. You are starting a business and you have done some assessment and you understood that you need a capital of 10 crore for starting this. Let us think in big scale. Okay. You need a capital of 10 crore. And luckily, this is the capital you also have. Why you need this capital of 10 crore? Let's say for investing in land and building, plant and machinery, furniture and fixture. So this is what you believe. So land and building, let's say this is around 3 crore and this is around 6 crore. This is around 1 crore. So overall, you have brought in or mobilized 10 crore as capital and you have used that for creating these kind of assets. It means now you have basically created an infrastructure for running a business. Okay. Now, at this point, you have set the basic infrastructure. Let's say a customer walks in. Let's say a customer walks in and he is placing his first order. He is placing his first order. Now, in this occasion, when you receive the first order from the customer, will you be happy or you will be sad? Maybe I'll put it like this. Will you be happy or you will be sad, or more than that, you will be worried? You have set your infrastructure. You have brought in capital, whatever you had, 10 crore. You have used that for creating all this. And customer walked in, he is placing the order. You received the first order, you got to execute. Whether you will be happy or you will be worried at this point. Yeah, please answer. I mean, if you're happy, just type H. If you're worried, type W. Yeah, it could be mixed emotions, like many of you said. Yeah, Indrani said worried, Narendra both, Debashish happy, Santosh worried, Adil worried, Sneharani both, Balaji, sorry. Yeah, Dinesh is saying mixed feeling, Harish is happy. Yes, it can be. It can be a combination. You can be happy because you got your first customer. Wow, you got your first customer. It means you are ready to set the ball rolling, right? But you will get immediately worried because you will get a question, how I will fulfill the order? How I will fulfill the order? Because he has placed an order. It means I have to deliver goods for him. This order means what? I have to deliver goods. If I have to deliver goods, I have to produce goods. Okay. Or I have to at least do trading, buy and sell. And if I have to produce goods, if I am a manufacturing company, then I have to make use of factors of production. I need a raw material. I need a labor. I need various manufacturing processes. So unless and until I invest in raw material, invest in labor, and invest in other activities, let me put it like other activities, I cannot produce the good. And unless and until I produce the goods, the sale will not happen. Yes or no? The sale will not happen. So here, what happened is I have created a big infrastructure. Maybe I may be having a big building, right? I'm having a big building. I'm having machineries. I'm having furniture. Fine. But if I want to execute this order, what is required is, along with these, what is required is I should also have raw material. For that, I need cash so that I can purchase the raw material. I should also invest in labor so that they will work on the activity. I should also invest in other activities, let's say consuming power, let's say transportation, moving the goods. Let's say I have to invest in fuel. Let's say I have to incur other miscellaneous costs like this. So unless and until I invest over here, this investment will not fetch any result. This will not give me any benefit. Yes or no? How many of you agree with this? There is no point in creating big infrastructure like this without investing in this area. So what is this investment? The investment what I'm going to make in raw material, the labor, the other activities. What is these investments will do? These investments only will help me to produce the goods. And only when I produce the goods, I will be able to sell. And only when I sell, I'll make cash. And only when that happens, my business will start moving. If that doesn't happen, nothing is going to move further. Let me relate this with an example of a car. Okay, I'm going to draw something as a car. Please accept it as a car. Okay, this is a car which we used to draw in our school days. Let's say I want to make use of this car. I want to put this car into business. Let's say a business like Uber or Ola. And I don't want to drive it because I don't know how to drive. So I don't want to drive. It means for driving this car, I also have to engage a driver. I also have to engage a driver. Just a moment. Yeah. It means if I have some 10 lakh rupees with me, that is 1 million, I can go and purchase the car. But if I want to ensure this car is going to generate revenue for me, that is, if the car has to generate a revenue for me, it should come out of the showroom. It should start running in the roads. And for that, two critical things are required. If the car has to start running, two critical things are required. One is the fuel, right? The other one is the driver. And both demands money. I have to pay for fuel. I have to pay for driver, right? So unless and until I set aside some additional money, let's say, and another 1,000 rupees towards fuel, and let's say another 20,000 or 25,000 as salary for the driver, this 10 lakh will not fetch any value. Yes or no? This 10 lakh investment will not fetch any revenue for me if I'm not going to set aside another, let's say, a bare minimum of 21,000. If I don't put this 1,000 rupees fuel, the car is not going to come out of the showroom or it's not going to run. And if I don't engage a driver and if I'm not ready to pay him, let's say this driver demands salary upfront, then unless and until I spend this 20 plus 1, 21,000, this fixed asset will not generate any revenue for me. So for buying this car, I have brought in a capital, which is long-term capital, or I can call it as even the fixed capital. But if I want to ensure this car is going to run, this car is going to generate revenue, then in addition to this, I should also invest in some small capital so that the car will start running and it will start generating revenue for me. So the capital which I have to set aside to ensure the car is going to work on a daily basis is called as dash capital. What it is? Please fill the blank. The capital which I have to set aside to ensure this asset is going to work for me on a daily basis is called as working capital. Okay, this is a very basic elementary introduction for working capital anyone can give. Or we can also call it, like Dinesh is saying, we can also call it as a running capital. Okay, so working capital is the capital required for day-to-day running of the business. Day-to-day running of the business. And here, what we have understood is it is not sufficient that you just invest in infrastructure. You should also invest in all this. Only then you will be able to move further, right? So let me reproduce that here. Let's say I got this gyan. I understood that we should set aside some additional capital. Only then our business will have day-to-day running. So I'm bringing some additional capital, let's say in the form of a cash. So now I have cash. Now what I will do, I will use this cash and go and purchase raw material. Assume it is a manufacturing business unit. Okay, I will purchase raw material. Then what will happen to this raw material? It will be taken to a production process. Okay, so when it is taken to production process, the raw material will get converted or it will be in various stages of production. So technically we will call that as work in progress. We will call it as what? Work in progress. And when the work in progress is completed, what we get is finished goods. What we get is finished goods. And if the finished goods is immediately sold, directly you will get back your cash here. But some customers may not pay the cash immediately. They may demand credit. So if customers are demanding credit and if you're selling to them, you are not going to create cash. You are going to create another class of asset. It means using the cash you have purchased raw material, you have converted into finished goods. All these have happened. But now you are not converting the finished goods into cash by selling. You are rather creating a different class of asset. What it is? Unrealized credit sales, right? You have sold on credit, but that money is yet to be realized. So unrealized credit sales is called as dash. Is called as dash. What is the answer? I could see, yeah, some of you. Yeah, Ajay, Nitish, Santosh. Yes, we are creating a new class of asset called debtors. Debtors are those customers who have purchased goods on credit, but they are yet to make payment. It means they are within the credit period, or they are even outside the credit period, but they have purchased goods on credit, they are yet to make payment. Okay. Then what happens? Eventually, these customers will make payment. So you will get back the cash. So what happened? You have understood that if you want to ensure your business is going to run on a daily basis, it is not sufficient you just invest in long-term assets like land, building, machinery. You also have to bring in some cash, and that cash got to be used for raw material, production process, finished goods. Then those things will go and get logged with the customers. Then eventually it will come back as cash. So it might look like a simple cycle. Simple cycle. We call it as what? Cash to cash cycle. This cycle also has got another name. This cycle also got another name. What is the other name for this cycle? What is the other name for this cycle? This cycle is also called as dash cycle. This cycle is also called as operating cycle. This cycle is also called as operating cycle. If you believe this cycle is working capital cycle, a small modification is required. A small modification is required. Please understand this cycle as operating cycle, meaning in the operation, I put the cash. Okay, in the operation, I put the cash, which is used for purchasing raw material. Then the raw material along with the additional expenses like labor, electricity, fuel, transportation, all those costs, it is getting into work in progress. Then they are becoming finished goods. Then they are sold to customers. Then the customer is making the payment. So this is my normal operational period. Okay. I will call this as operating cycle because it is because of my operation. I will not call it as a working capital cycle. It means there is a slight difference between the operating cycle and the working capital cycle. What is working capital cycle? See, here you are purchasing raw material. It means you are paying cash and you are purchasing raw material. It means your cycle starts here, right? But let's say your suppliers are giving credit. Your suppliers are giving credit. Then there is going to be a slight difference in this scenario. How to understand that? For that, we have to understand for how many days I'm going to keep all these items. Only then we will be able to appreciate the difference between operating cycle and working capital cycle. See, now I want to hold raw material with me for a certain number of days. Now, please tell me if it is a vegetable shop, for how many days we will keep the materials or the fruits or vegetables received in stock? Please tell me. If it is a vegetable shop, max how many days? 1 day, 2 days, say max 3, 4, 5. Yeah. Okay. If it is a non-perishable product where you can keep it for several days, then it actually depends on various factors. Okay. It actually depends on what is the cost of those products, how much you can afford to invest in those items, right? So for how many days you are going to keep the raw material will be decided by various factors. So it is dependent on whether the product is perishable, okay? It is non-perishable. And it also depends on the availability of the product. How long the product will be available? Is it seasonally available or is it regularly available? So when it is seasonally available, what you will do? You will try to buy and hold them when it is available. So at that point, you will have more stock. Then later days, the stock level will come down. Okay. And if the product availability is free, it means there is no compulsion to hold for a longer period, then you might hold the material on just-in-time basis also, because there is no point in buying and holding for a longer period, because if I place an order today morning, I will get it in the evening. Why? Then in that case, what is the reason to hold it for much higher level? Are you all with me? So for how many days the raw materials will be held is the major question in understanding the operating cycle or say the working capital cycle. Let's say my business model says I have to maintain raw material for 15 days. I have to maintain raw material for 15 days. What does that mean? It means at all point of time in my godown, let's say this is godown, in my godown, I should have the raw material stock to a certain quantity, which if compared with the annual raw material consumed, okay, if compared with annual raw material consumed, it will be equivalent to 15 days. Are you all getting me? When I say I'm holding raw material equivalent to 15 days means I will see what is the annual raw material consumed. Let's say I consumed a certain number of kgs. Let's say I consume 120 tons. If I'm consuming 120 tons of raw material in a year, then what will be my raw material consumption per month? 120 tons divided by 12. Per month, my raw material consumption is what? 10 tons. Yes or no? Right? 10 tons. I mean, per annum, I'm consuming raw material for how many tons? 120 tons. It means per month, I will be consuming 10 tons. And here I'm saying I will be maintaining raw material equivalent to 15 days. It means how much raw material will be in godown all the time? All of you, please tell me. My godown will always have raw material equivalent to 5 tons. Maybe if I express this in value, let's say 1 ton is 1 crore worth of raw material, then 5 ton means it is 5 crore worth of raw material. It means my business model says I should always have 5 crore worth of raw material. I repeat once again. Please, all of you listen to this. My business model says I should always have 15 days worth of raw material. So some will wonder, what is this 15 days? What is this concept 15 days? Why I am saying the raw material in days terms? For that only I am giving you this information. If this business consumes raw material for one full year at 120 tons, one full year raw material consumption in production is 120 tons. It means per month they are consuming 10 tons, 120 divided by 12. Per month they are consuming 10 tons. It means half a month they will be consuming 5 tons. So 5 tons worth of raw material is what in their godown. And this 5 tons equivalent value is 5 crore. So the message is they may be holding the raw material worth 5 crore. Okay. But that 5 crore is equivalent to what? 15 days of their annual raw material consumption. Is this clear for all of you? Is this clear? Just type clear. Because from here only we are going to build on things. Okay, Riyat. So if I am saying 15 days, it is derived in this fashion only. Okay. Now the question is, why 15 days? Why not 10 days? Why not 20 days? Probably it is based on their inventory management practices. Every organization will have their own inventory management practices. They will have something known as economic order quantity. They will have something known as economic order quantity. And you know what is the beauty of this economic order quantity? This will ensure if the inventory is maintained at this economic order quantity level, then their cost of storage and their ordering cost will be minimum. Both put together will be minimum. So many organizations will arrive at the raw material holding level based on this economic order quantity computation. It's a slightly mathematical computation. I'm not getting into that, but many organizations, they fix the certain number of days of raw material by arriving at the economic order quantity. It means here we have assumed this 15 days quantity is equal to 5 tons, right? It means they would have come to a calculation that if they hold 5 tons of raw material at all point of time, or if they order 5 tons of raw material, their cost of storage and ordering cost will be minimum. So the cost associated with the raw material will also come down for them. Okay, it's a technical element. Let's not go deeper into that. So that could be the reason they would have chosen 15 days. So it can vary. See, for some organization, if the goods are available immediately after the order placement, then they will go for JIT, JIT stands for just in time. So those kind of organization, they may not have 15 days of raw material. What they may have is maximum 1 or 2 days of raw material, just to have a buffer in case just in time is not delivered. That's it. Okay, right. Now, 15 days of raw material is always invested. It means 5 crore is invested and logged all the time. All the time there will be 5 crore worth of raw materials in the godown. That is the message which you have to carry. Then comes work in progress. So what is work in progress? It is a production process where the raw material will be put into the production process. It will go inside the machine. Then you will get the output. You will get the output. Okay. So raw material, here you have people working on it, and you will have various activities going on. You will consume power. You will do lot many processing and other things. Then finally, the finished goods will come. So this activity will take some time. So in some businesses, you will see it is very short period. In some businesses, you will see it is very long period. I've seen in some technical textiles where it will take up to 25 days to convert the raw material as finished goods. And in some cases, I have seen where the duration will be very short, where you will get the output in a matter of half an hour. You put the input, you get the output in half an hour. In certain cases, it will be like 1 or 2 days. You put the input, you start with the raw material today, in 2 days, you get the output. Okay, so it all depends on the business model, the technology they have adopted, they have used all this. Okay, now in this example, let us assume the work in progress is going to take another 5 days, another 5 days. So what is happening here? I'm putting money in raw material, and that is locked for 15 days. Then for another 5 days, that money along with additional money for labor, for let's say for labor, for manufacturing cost, for power and fuel cost, another 5 days is gone. Then comes the finished goods. And finished goods, when it comes, it can come as a hot cake, in the sense it can get sold immediately, or it may demand some additional marketing efforts to push. So not all the businesses will be in a position to sell the finished goods immediately. They may take time. They may take time. Let's say, for example, uh, textile. We'll take the textile itself. And we have a classic participant here. I think Naveen from dairy industry. Naveen, please tell me, what is the raw material holding period, work in progress period, and finished goods period? For how many days you will be holding the raw material? How many days it takes for your organization to convert that as finished goods? And I believe your finished goods will not hold for a longer period. Naveen, if you're there, you can just give your answer. So, okay, Naveen is saying it's around 7 to 15 days. So we were almost twice of that. And finished goods will be held with the company maybe for two reasons. It may lie in godown, it may lie in godown, or it may lie in various places meant for sale. So sometimes it will get sold immediately, it will take time also. Let's say it is going to take 10 days time for me to finish off, sell off these finished goods. So what is happening now? The cash what I have brought in, invested in raw material, got locked for 15 days. It got logged in work in progress for 5 days, and it got logged as finished goods for 10 days. It means already 30 days my money is locked. Then eventually I find a customer, but that customer says he wants credit. He says he will pay after certain number of days. Let's say this customer is demanding 15 days credit. This customer is demanding 15 days credit. If that happens, then you visualize the cycle of the business. You visualize the cycle of the business. The cycle goes like this. Cash is put into raw material for 15 days, right? It got locked there. Then for 5 days, it got locked in the production. Then it got locked as finished goods for 10 days. So 15 plus 5 plus 10, it is 30 days. It got locked in inventory itself for 30 days. Then customer is taking 15 days to make the payment. It means effectively it takes 45 days to get back your cash. 45 days to get back your cash. Yes or no? So this cycle is what we call as operating cycle. Just give me a moment. There is a small noise. I'll clear it off. Yeah. So this cycle is what we call as operating cycle. And at times this operating cycle can also become working capital cycle in an exceptional cases. I'll tell you what it is. Now let's try to digest this cycle. Now, if I put cash now on day 0, when I will get back this cash? When I will get back this cash? Keep answering because it's going to be iterational kind of question. When I will get back the cash for completing one cycle, I will get it in 45 days. So this is my cycle 1. And when I will be able to make my next set of purchase? Maybe on the 46th day. And when I will get back the second cash? If I start my second cycle on 46th day, when I will get back my second cash, it will happen on the 90th day, right? So on 91, if I repeat the process, when I will get back the cash? 90 plus 45, it is 135. Okay. This is my third cycle. And if I start on 135 once again, when I will get back my cash? 180. So what is happening? Fourth cycle. And I can repeat this once again. So please give me the numbers. I start on 181. 181 plus 45. How many cycle? I mean, how many days? 45 days. So it is going to be 225. This is cycle number 5. And 226 to how much? Is it 280 something? 45 or 260? 270. Okay. 270. Then 271 to how much? 315. This is 7. And 315 to 360. I have taken a longer cycle. Normally in my explanation, I'll use 90-day cycle. But in this case, I have used 45 days cycle to explain you something very important, very beautiful. So look at here. This business is taking 45 days to complete one cycle. And if you see, only on the 45th day, they will get the cash. And only that happens, they can make the next purchase on 46th day. And then they have to wait for 90 days to get back the cash. Only then they can make the next purchase on 91st day. Now my question is, do you think a business will be able to survive if it is going to be fully dependent on these days cash inflows? Do you think a business will be able to survive if it is going to be dependent on cash inflows happening only on every 45 days? Answer is no. Because if you are going to make purchases only on 46, 91, 135, then you are not an established buyer. And if you are going to make salary payment to your employees only after every 1.5 months, they are not going to stick with you. Your expenses are recurring in nature. They may be monthly or weekly. And your income, or say the inflow, is as per the cycle, as per cycle. And in this model, we cannot survive. If you want to survive like this, and then if you want to grow like this, you have to make continuous noise in the market. You have to make continuous noise. In the sense, you should be a regular buyer. You should be a regular seller. You should be a paymaster. You should pay your expenses. You should pay your employees, everyone on time. But nothing will happen if you are going to be dependent on this. So what is happening here is you are bringing cash, you are investing in raw material, you are investing in work in progress, you are investing in finished goods, you are investing in debtors, and then only you are getting cash. And if you are dependent on this cycle, it's going to be very difficult. So what should happen is, whenever you invest money in raw material, whenever you go cash dry, you should get some more cash. Whenever you invest money in production process and you go cash dry, you should get some more cash. And whenever the money is getting locked with the finished goods, debtors, and whenever you go cash dry, you should get some cash. you should get some cash. Now the question is, who will give this cash? Who will give this cash? It is easy to say you should get some cash whenever you are investing money here. But who will give this cash? Let's try to understand that. See, so basically what is happening, if we want to run our show successfully, we have to invest in inventory. I hope all of you agree with that. We have to invest in inventory, basically the raw material, the work in progress, the finished goods. Then we have to invest in debtors. Unless and until we are ready to sell on credit, we may not be able to find customers in many of the cases. So unless and until we invest in these assets, we may not be able to run our show. So look, now the statement, what we got in the form of a statement, has originated from our discussion on the cycle. We started our discussion by trying to understand the operating cycle. We understood that money is getting logged in various stages. And we understood that if we are dependent on cycle, it will be difficult. But we also understand that we have to make these investments, but we cannot afford to go dry. It means if you are making investment in these items, I can collectively call these items by some common name. Can somebody give a common name? Investing in inventory, investing in debtors. If I'm making a collective investment in these items, these assets, yes, we'll give a name for these assets. Wonderful. We'll call it as current assets. If I have to invest in current assets, meaning if I have to invest in inventory, if I have to invest in debtor, then I need some sources, some recurring source, some regular source, so I do not go dry. So what are the possible sources which we can think of for funding these guys, for funding inventory, for funding debtors? Please give me. What are the possible sources we can think of? Yes, we can think of bank credit. Bank credit can be in the form of cash credit. It can be in the form of overdraft. Okay. Then we can also think of some other credit. Can somebody tell me? Some other credit, some other credit. Creditors, yes, supplier credit, trade credit. We'll say trade credit. Trade credit, or generally we will see as sundry creditors, right? So for funding these current assets, we have two different sources now. And what is the uniqueness of these two sources? Money coming from bank credit, trade credit. Is it short term or long term? The money coming from these sources, is it short term or long term? These are short term in nature. So I want to give a technical name for these money. Can you give a technical name? If these are current assets, I want to give a technical name for these money. Yes, the technical name for this money is current liability. Current liability. So look where we started. We understood that if a business has to run on a daily basis, they have to invest in inventory, they have to invest in debtors. Okay, this is very specific to manufacturing company. In case of a trading company, there may not be any raw material, there may not be any work in progress. They will buy and sell finished goods, they will create debtors. And in case of service, there is no inventory at all. They will have only debtors. And for funding this, there is a corresponding sources, current liability, bank credit is available, trade credit is available. Okay, but if you now see the size on the right hand side, I think the size is bigger. It is bigger. On the left hand side, comparatively, it is smaller, right? It means still there is some area that got to be funded. So who will fund this? You have created some current assets. Some of the portion has been funded by current liability already, which is short term in nature, right? Short term. It means the remaining portion of the current assets have to be funded by the owners by arranging long-term funds. So this can come from long-term funds. So when long-term funds that comes to fund the creation of current asset, technically we call it as net working capital. Net working capital, NWC. Got it? Okay. So the learning for us now is, in order to ensure business run on a daily basis, they have to invest in working capital. And for investing in working capital, funds can come from short-term sources and long-term sources. When funds come from short-term sources, we call it as current liability. When funds come from long-term sources, we call it as net working capital. I'll just touch on that. Now listen carefully. This current asset has got another name called gross working capital. Gross working capital. And how did we arrive at the net working capital here? We took the total current asset. Okay, let me give some number. Let's say the raw material, work in progress, finished goods all put together is around 50 crore and debtors is 50 crore. Okay, so that makes total current assets of 100 crore. And let's say the bank credit is 45 crore. The trade credit is 30 crore. Okay, now tell me, what is the net working capital here? What is the net working capital? It is the balancing figure, 100 minus 75, that is 45 plus 30. So it works out to 25. And how we got this net working capital? Net working capital, we took the total current asset. From that, we deducted the other current liability. So other current liability included basically bank borrowing plus trade credit plus all other current liabilities, if any. In this case, total current asset is 100 crore. Other current liabilities are basically 45 plus 30. So it is 100 minus 75. So net working capital is equal to 25 crore. So now we may have the question, what is this net working capital? We know it is a balancing figure, 25 crore, but from where this 25 crore is coming? From where this 25 crore is coming? For that, once again, let's go to the balance sheet picture. Balance sheet, current asset 100 crore. Balance sheet, current asset 100 crore. And you got current liability as 75 crore. It means we said the remaining 25 crore is net working capital, but this net working capital is nothing but long-term source. Long-term source. Why this is long-term source? Because in balance sheet, there can be only two sources. One is short-term source. Current liability is short-term source. If current liability is short-term source, the rest can be only long-term source. Are you all with me? In balance sheet, the side which shows the equity and liability, basically the sources of funds, we can classify the source of funds only into two categories. One is short-term source, the other one is long-term source. If the 100 crore of current asset is funded by current liability, meaning 100 crore is funded by short-term source of 75 crore, then obviously it means the remaining 25 crore is funded by long-term sources only. So this long-term source can be a combination of term loan. It can be a combination of profits or retained profits. It can be a combination of capital. So look at here. This business has created a current asset of 100 crore. For that, it raised 75 crore through short-term funds, 25 crore through long-term funds. This long-term fund can be any money, a combination of a term loan or retained profit or the capital contributed by the owner. Now, to give you a even more finer picture, Let me just demonstrate that here. Look at here. This business has a capital of 10 crore. Okay. Reserves and surplus of 5 crore. 5 crore. And it has some long-term debt. Let's say a corporate loan, which was raised specifically for supporting the business working capital of 10 crore. So what is happening now? They are having capital, reserves and surplus, corporate loan. Okay. And let's say they also have a term loan raised specifically for funding some asset. They have term loan of, let's say, around 20 crore. Okay. And we have this current liability of 75 crore. Current liability of 75 crore. And let me just make a small modification to the capital figure. Capital figure is 15 crore. I'll explain why it is. Okay. Now, let's look at the total. What is the total? Somebody please tell me. It is 75 plus 20 plus 25. It means they have, is it 125 or 120? 75 plus 30 plus 20. Okay, it is 125 crore. They have 125 crore funds. And if you look at the composition of this 125 crore, you have to be very clear. 75 crore has come from short-term sources and the remaining 50 crore has come from long-term source or long-term funds. Okay, this is, let me clear. This is short-term source and this is long-term source. And how they have used this for current asset 100 crore. For current asset 100 crore. It means they have spent some 25 crore on fixed asset or some non-current asset. So their balance sheet is tallied. Now please digest this. This business has invested 100 crore in current asset. And if you ask me what is the source for this 100 crore, it is 75 crore of short-term source and 25 crore has come from long-term source. What is the exact long-term source? I may not be able to map. Why? Because they have the overall long-term source of 50 crore, right? Overall long-term source of 50 crore. Maybe we can say out of this 50, they have used 25 for creating fixed assets. Yes or no? They have, what is the total long-term source? They have total long-term source of 50 crore. Of the 50 crore, they have created fixed asset worth 25 crore. It means the remaining long-term source is used for funding current asset. Yes or no? Yes or no? They have 50 crore. Of that, 25 crore has been deployed here. Another 25 crore has been deployed here. It means this current asset of 25 crore is funded by 75 from here, 25 from here. That's why we say net working capital is equal to current asset minus current liability, because we may not be able to map it exactly which long-term funds has been used. Maybe when they raise the fund, they know very clearly. Okay, so we say 100 minus 75, net working capital is 25, which has come from long-term funds. Long-term funds is a big bucket. In this case, if you see, the long-term funds is a big bucket. Yes. And where is the bucket? This is the bucket. This is the long-term funds bucket. Of that, 25 crore has gone over here. Another 25 crore has gone over here. Is this clear, all of you? Please type AC if clear. Happy? Okay, now listen. Okay, why we got into this discussion? I mean, we were basically looking at the sources of funds. So current assets can be funded by various sources. One is net working capital. Net working capital is nothing but long-term funds. See, the mathematical formula for net working capital is very simple. Current asset minus current liability. But the understanding is this is basically the long-term funds like this, which had come for building the current asset. Then the other source for funding the current asset can be the components of the current liability, which can be like trade credit or supplier giving credit. Okay. Then comes the bank fund. Then comes the bank funding. So what are the ways the banks can fund the working capital or say buildup of current asset? Please tell me. Please give your answer. In what forms or through what credit facilities banks can fund current asset? Yeah, I could see Saurjit, Arun Kumar, Harish, Anshu Kumar, Fani Kumar. Yeah, so I'm getting different answers, but they're all interconnected. Yes, bank can fund the current asset creation in two different forms. They can do it in fund-based form. They can do it in non-fund-based form also. Yes, bank can give cash money to the account of the borrower and allow the borrower to avail the money so that they can use it for working capital purposes. So that is called as fund-based credit facilities. Instead, bank can simply give one letter, a document, which will do certain purposes or certain activities, what money will do, real money will do. Okay, that is called as non-fund based. So the fund-based credit facilities can be in the form of cash credit, it can be in the form of overdraft. Nowadays, banks are also giving WCDL, working capital demand. Not nowadays, it was there for quite a long time. Working capital demand loans. So the fund-based credit facilities can be like this. These are all the traditional products. Then depending upon the activity, I mean, if they are into export, then there will be like export credit for pre-shipment, post-shipment. Things go deeper and deeper. But the understanding is when we say fund-based credit facility, it means there is actually a flow of money from bank account to the borrower account to the designated account. From there, they can use the money for making various payments. Okay, that is fund based. In case of non-fund based, no cash flow will happen from bank to the borrower. Rather, what will flow is only a document or say a letter or say a guarantee, okay, to the beneficiary, those kind of things. It means these non-fund based credit facilities will be in the forms like letter of credit, bank guarantee, which are widely used. I mean, mostly the construction related companies, they'll be insisting for bank guarantees. And bank guarantees also will be required for various statutory authority submission purposes. Letter of credit, you will see mostly in international transaction where the buyers and seller are in different geographies. So there will be lack of trust among both the parties. So to cover that. So these are all the fundamental. I'm not going deeper into the intricate products or intricate facilities. I'm just giving you the layer level understanding. It means current asset has to be, I mean, current asset can be funded by bank in fund-based form, in non-fund-based form. So within LC, yeah, like Anshu Kumar was saying, it can go into various subdivisions. Okay. So now we have reached to a point that bank is funding the current asset. So why bank is funding the current asset? Why bank is giving cash credit? For that you need a knowledge of all this. Are you able to appreciate now? See, where we have landed now, we have landed on the discussion of cash credit overdraft. Why they are giving? Because it is fund-based facility. Fund-based facility for what? Because it is coming under bank funding. Bank funding of what? Current asset. Why current asset? Current asset because business has to invest in current asset. Why they have to invest in current asset? Only when they invest in current asset, they will be able to do their day-to-day activities. Only then they will be able to complete the cycle. Only then they will be able to make profit. Are you all getting me? Only then they'll be able to make profit. And here I said there is one beautiful concept which we have to understand. See, here this is the cycle. And if a business can arrange funds to manage this cycle, you will see something beautifully happening. See, for 45 days, this business has to starve without cash, right? In that place, if it is arranging cash credit, what will happen? It can it can sustain the 45 days without being dependent on this cash. Yes or no? It is going to lock its money for 45 days. In that place, if it can arrange an alternate fund, so it can meet its raw material purchases, pay labor, incur all the manufacturing cost, maintain or manage the fixed asset holding cost, debtors collection cost. Okay, if it can manage all this in this 45 days with the support of cash credit and the networking capital, it means on day 0 it is investing money, on day 45 it is getting back money, right? And in this period it need not worry about the 45 days gap because there is an alternate money available. And do you know what will happen because of this? The show will run without any issue, and on the 45th day when the money comes, the cycle will start once again. And when this is repeated, what is happening? The business is getting opportunity to make sales again and again. So how many cycles they are going to have? They are going to have 8 cycles. It means they are getting opportunity to make profit 8 times. Yes or no? They are getting opportunity to make profit 8 times. So here they invest. On the 45th day, they get back money, and the sales money comes back with profit. And that is going in once again. And it is happening. So here the message is, number one, they have to have alternate funds like CC funds to manage this 45 days. And message number 2 is they have to keep this gap as short as possible. As short as possible. Why did this company had 8 cycles? They had 8 cycles because their operating cycle is only 45 days. And because of that, they are getting opportunity to make profit 8 times. They are getting opportunity to make profit 8 times. Now, tell me what will happen if their cycle had been 90 days. If their cycle had been 90 days, what would have happened? How many cycles they will repeat? They will have only 4 cycles. It means they will get opportunity to make profit only 4 times in a year. So in which cycle they are going to make profit, more profit? Is it 45-day cycle or is it 90-day cycle? Is it 45 or 90? Yes, it is in 45-day cycle. In 45-day cycle, they are going to make more profit. But in which cycle, as a banker, you have more opportunity to make business? In which cycle, as a banker, you have opportunity to make more business? It is in 90 days. In 45 days, yes. But in 45 days, their requirement will be less. Here, in 90 days, their requirement will be more. But for business, which is healthy, for business, this is healthy. For bankers, this can also be okay, as long as this cycle is in sync with industry level. If the industry level is 90 days and if the business is having a cycle of only 45 days, it means they are doing exceedingly well. 45 days is healthy for the business. They are doing exceedingly well. If the business cycle is 90 and if the industry cycle is 90 and if the business is having only 45 days, it means they are outperforming the industry. It's great for them. But if the reverse is happening, if the industry cycle is 45 days and if the business is having a cycle of 90 days, will you consider funding this business? It means something is wrong. Yes or no? Something is wrong. Everyone in the industry is having a cycle of only 45 days, but this guy alone is having 90 days. It could be on account of high debtors. If debtors are high, if debtors are not making payment on time, the cycle will go elongated. And if that is elongated, then there is a possibility that this account will turn out to be a non-performing asset. It can become non-performing asset. Okay, so it is very important you understand what is their operating cycle, not merely computing. See, because we just computed 45, the 45 can become a normal cycle if the industry cycle is 45, and if the company is also having 45, it is good. But if the industry cycle is 90 and if they are having 45, it is great. So you cannot come to a conclusion whether the cycle is good or great just by looking at its standalone numbers. You should also compare it with the industry level. You should compare it with the past. Okay, you should compare it with industry. You should compare it with peers. Then only you'll be able to frame a good opinion about the cycle. Okay, so how to determine this turnaround cycle? That depends on the holding period. See, as far as the industry is concerned, you have to subscribe to the industry cycle data. I mean, many industry bodies, they come out with a publication, and many banks, they would have generally subscribed to that, or they will come out with a monthly or quarterly reporting on what is the general pattern of the cycle prevailing for each and every industry. Okay, that is basically an insider data which you will be able to get from your own organization through their corporate subscription for details like this. Okay, now coming back to the discussion. So we have understood that current asset funding is important and it can be funded by banks. Banks can do it in the form of cash credit overdraft, WCDL. So I'll just touch on this. Banks can give fund-based facility in the form of cash credit overdraft. How they do it? How they do it? Yeah, Anand is asking, is it covered in financial analysis? If you have enrolled in Creighton Financial Analysis course, yes, there is a dedicated module. And Kuldeep Rana, whether we will get the recording for this class, if you're a Diamond member, you will get. Okay. Now, this fund-based credit facility, as we discussed, it can be in the form of, say, cash credit or overdraft, whatever the name you call it. It is given by the banks in two different categories. I mean, probably they have categorized it on the basis of the limit itself. If the limit is up to 5 crore and the limit is beyond 5 crore, they have adopted some approaches. So if the requirement, that is the cash credit requirement, is up to 5 crore, they assess the limit using a method called turnover method. Turnover method. And if it is above 5 crore, most of the banks, they follow a method called MPBF method, that is maximum permissible bank finance method. This turnover method is relatively simple. It is relatively simple. What they will do, they will see what is the estimated turnover. Okay. On the estimated turnover, they will apply 20%, and that will be considered as eligible bank finance under turnover method. Eligible bank finance under turnover method. Look, it looks like a simple computation. Yeah, Jweldas, you need real data analysis, right? That is given in the Credit and Financial Analysis Mastery. Here, my objective is to introduce. Yeah. Now listen. Turnover method says you can arrive at working capital requirement, or not working capital requirement, say eligible bank finance as estimated turnover into 20%. So now the question is, how do you arrive at the estimated turnover? This becomes the challenging area, because many borrowers will give some fancy rosy turnover. Rosy turnover. What is going to happen? They will try to project a higher income. So they can get 20% of the higher income as the eligible bank finance under this method. But as a banker, or each and every bank will have some kind of a specific policy when it comes to accepting the estimated turnover. I mean, they will not blindly accept whatever the turnover given by the borrower. So let me just go a little deeper into that. Turnover method says the eligible bank finance is EBF. Eligible bank finance is 20% of estimated turnover. Okay. So what could be the estimated turnover? Estimated turnover can be either the turnover estimated by the borrower, which can be very rosy or ambitious most of the times, or it can be based on certain specific factors decided by the bank. Can some of you tell me what are the other factors banks will consider while freezing this estimated turnover? Yeah, Manjunatha is saying based on audited financial certain percentage hike. Let's say 20% increase over previous year audited turnover. Yeah, Divya is saying 25%. Okay, so some banks, I've seen some banks have a policy saying 25% growth over average data. Sorry, over, let's say, 3 years average sales. 3 years average sales. Yeah, last 3 years average. Suresh Babu. So it can be any number. Let's say, for example, a borrower is estimating a turnover of 10 crore, whereas 20% growth applied over the previous year is working out to only 8 crore, and 25% growth based on past 3 years average is working out only to 7.5 crore. In those cases, even though the customer is saying they will achieve 10 crore, what most of the bank will do, they will compare all the three. Customer is saying 10 crore, but based on the past year sales, on that by applying 20% growth, it is working out only to 8 crore. Or by looking at the last 3 years growth, it is working out to only 7.5 crore. So let us go for whichever is lower. So most of the banks will adopt whichever is lower, 7.5 crore as estimated turnover. Okay, this is what most of the banks. Any of you have adopted similar approach? Let me know. Any of you have adopted similar approach? Yes. Yeah, I could see some. Divya and Kumar. Yes. So this is how they do it. It means turnover given by the borrower is not ignored. Turnover given by the borrower is not ignored. Estimated turnover is chosen like this. And what is the formula I prescribed under this turnover method? Can somebody tell me how the eligible bank finance is arrived using the estimated turnover? Eligible bank finance is calculated as estimated turnover into 20%. Is that right? Did I give you this formula? Yes? Yeah. Okay, now listen. I'll show you what is the origin of this formula. So once you understand that, then this formula will make sense. See, this Nayak committee only recommended the turnover method. So what they believed is a business will have current asset equivalent to 25% of their estimated sale. Equivalent to 25% of the estimated sale. So this was their general assumption. They said SME or a small business or small and medium enterprise business will have current asset equivalent to 25% of the estimated sale. If current asset is equivalent to 25% of estimated sale, then banks can fund certain percentage of this and balance can be brought in by the promoter. Okay. So let me put it here. So the current asset is going to be 25% of sales. Of this, banks can fund 80%. 80% of this. So this is called as working capital requirement. Banks can fund 80% of working capital requirement. It means remaining 20%. Remaining 20% of this should be brought in by the owners in the form of margin. In the form of margin. So what is this 80% of working capital requirement? Let me give you some number. Let's say the current asset is 1 crore, or let's say the turnover is 5 crore. If the turnover is 5 crore, what is the current asset buildup? 25%. It is 1.25 crore, right? It is 1.25 crore. If current asset is 1.25 crore, 80% of the current asset, how much it is? 1.25 into 80%? It works out to 1 crore. Got it? It means this remaining 0.25 crore has to be brought in by the owner as margin. Now, if you see this 1 crore, which is 80% of working capital requirement, is also certain percentage of turnover. What is the percentage? Please tell me. This 1 crore is also certain percentage of the turnover. Yes, it is 20%. And that is the reason we have this formula. Estimated bank finances, estimated turnover into 20%. But if you look at the origin, it is basically turnover. 25% of the turnover is considered as current asset, and 80% of the current asset, that is working capital requirement, is funded by the bank, which is 1 crore, and that translates as 20% of the turnover. And do you know why they have assumed it as 25%? Any idea? Why they have assumed the estimated current asset as 25%? It means they made one rough assumption. 25% of annual turnover. 25% of annual turnover. Annual means how many days? 360 days, right? This is annual position. So what is 25% of annual? What is 25% of annual? It is 90. It means they have assumed that a business will have an operating cycle of 90 days. Are you getting me? Why the turnover method is financing 20% of estimated turnover? They are not blindly financing 20% of estimated turnover. By financing 20% of estimated turnover, they have come to a conclusion that a business is going to have a operating cycle of 90 days. Are you all with me? Are you all with me? Just type with you. Yeah, I'll come to that, Suresh Babu. Are you all with me? The turnover method says eligible bank finance is estimated turnover into 20%. It is not a blind mathematical formula. It is on the premise that a business is assumed to have 90-day cycle. If they are having 90-day cycle, then for 5 crore turnover, their current asset will be 1.25 crore. Then of that, 80% can be funded by the bank. So they can fund 1 crore. Okay, so now this gives rise to the question, what to do if actual cycle, what to do if actual is greater than 90 days? If actual is less than 90 days? If actual is greater than 90 days, if actual is less than 90 days, then ideally you have to assess based on their operating cycle only, not blindly by turnover method. It means you have to use MPBF method because it will not fit under the formula. Because this form, if you are using this formula, it means the inherent assumption is their cycle is 90 days. And it is also prescribed to help the business units. See, small scale business units, whether it is 90 days, 80 days, or 110 days, it will not make a significant difference. But for big business, for large scale business, when you are lending in crores, it will count. There's a saying, if you are underfinanced, if you're under financing a unit, for sure they're going to get into trouble. If you're going to underfinance a unit, they'll get into trouble. But if you excess finance a unit, they will get into even more trouble. How many of you could vouch for this? If you underfinance, for sure it's a trouble. If you excess finance, then that business will get into even more trouble than the underfinanced firm if they do not know how to manage funds, if they do not follow financial management principles. How many of you agree with this? Type agree, type agreed. Yes, Anshu Kumar pointed, overfinancing, excess financing leads to diversion. I think today noon or today morning, I highlighted that once again. 95% of the businesses fail, collapse because of financial mismanagement. And if you look at the main reason, it is on account of diversion. Diversion of funds raised for one purpose, but being used for other purpose. Diversion of short-term funds for long-term purpose. Okay. So answering the question Suresh Babu raised and many other raised, if the actual cycle is greater than 90 days, if the actual cycle is less than 90 days, and if it is very, very different, let's say actual is only 30 days, but this method assumes 90 days. Or say the actual, okay, here it is greater, right? Let's say the actual is like 120 days, but this method assume 90 days. If you assess as per the turnover method, then it will lead to under financing. Yes or no? This will lead to under financing because their cycle is 120 days and you are giving them semi-oxygen 90 days. They'll land in trouble. They will suffocate and they will always be in trouble. They will never have peace of mind. They will never be able to run business smoothly. And at some point of time, they'll collapse. But let's say the actual cycle is only 30 days. Okay. And you have given funding for 90 days. Do you know what will happen? First few days, they'll not know what is happening. Then they will realize that they got excess financing, which is equivalent to 60 days of their requirement. So they don't have any matching purpose. What they will do? They will start diverting. I mean, it will happen unintentionally. They won't do it intentionally because whenever they see their cash credit account, there will be unutilized amount. There will be a lot of money lying idle, unutilized. And if it is lying idle, the bank will levy commitment charges why you are not using. So they will start using. They'll start using for unnecessary purposes. And that's how the diversion starts. Okay. So if it is greater, then please go by what is their cycle. If it is less, go by what is their cycle. If not, you are actually putting them into trouble, and this could be even more. I mean, never ever do excess financing. It can be even more harmful, and the staff accountability issues will be severe when you do this. Right? Are you all with me? Yeah, sometimes they'll buy raw material in bulk for better rates. See, that is part of the inventory management. If their inventory management practices justifies that. That's why I talked about EOQ, economic order quantity. If ordering in bulk is helping them to save on their overall inventory management cost, then that gets justified. And that's what many seasonal industries does. Okay, that's what many seasonal industry does. Right? Are you all with me? So once again, I repeat, if actual cycle is 120 days, and if you are going by turnover method and if you are giving them credit only for 90 days, it means you are under financing the unit. You are under financing. It means that unit will never get what they exactly want. They'll get only 2/3 or they'll get only 3/4. It means there is always a shortage and they will never be able to do their business with peace of mind peacefully at all. Let's say their actual cycle is only 30 days, but you are following this method and giving them credit for 90 days. See, if you're following turnover method, it means you are giving credit for 90 days. That's it. Okay. It means you have given credit for another 60 days, which is a case of excess financing. And excess financing, initially, they'll not know that they are excess financed because they have financed as per the scheme, as per the rule. But the 60 days money lying unutilized, then gradually they'll start using it for unnecessary purposes. Then they will start diverting. They will start investing in fixed asset, or they may give it as loans and advances, and the money will eventually go out of the business itself. Then getting back that money becomes absolutely difficult. Okay, so that's the understanding of this method. So please understand, turnover method, the formula is prescribed to help the business units, the small scale business units, to get credit facilities easily without going through a complex calculation or elongated approaches. But when you do this assessment, when you are doing 20% of estimated turnover, you are giving them 90 days credit. So just ensure they do not fit in any of this. If it is actual is 80 days, 75 days, or let's say the actual is 85 days or 80 days, to that extent it can be managed. If the actual is, let's say, 95 days, to that extent it can be managed. But if there is going to be a wide deviation from 90 days, then ideally you have to go and assess through the next method called maximum permissible bank finance method, which we will talk next week. Next Sunday, we'll continue our discussion on working capital. So I hope session was useful. So if it is useful, please type useful. Please type useful. Diamond members, with your permission, can I introduce our Diamond Live membership? Diamond Live membership to other learners. If any of the Diamond members are here, please type Diamond permitted. Please type Diamond permitted. So with your permission, I can introduce the Diamond membership. Yes, I got the permission from Marna Kumar, Pulkit, Anand, Nand Kumar, Narendra, Shaju, Bhagwat. So thank you so much. Thanks for giving this permission. The reason why I take permission is they are the people who got benefited from Diamond membership. When I get permission from them, it gives me the utmost satisfaction. And yes, thank you, Saurajit, Balaji, Prabhakar, Divya, Gopal Gokhale, all of you, thank you. Now let me just quickly introduce what is Diamond membership. Diamond Live membership is a membership program which will give you access to our 130 plus online courses, which we have published in the domains related to banking, credit, finance, accounting, costing, and so on. It will also give you access to 100 plus ebooks, which we have published in these domain. It will give you access to all the live classes we are going to conduct, that is future. It will give you access to all the past live classes we have conducted, and it will give you access to all the publications we are going to come out, all the e-publications which we are going to come out. It means you will get access to all the courses, all the templates, all the ebooks, all the test series, whatever we are going to publish in future, you will get access to all this. And this is a mega membership. It's a big umbrella. This could be your final investment for learning in CA Raja classes. And whoever have already enrolled in our courses are also eligible for a deep additional discount. So to join this Diamond membership, what you have to do is you have to just drop a WhatsApp message now, 90251 00249. Okay, open your mobile and just send this message, Sunday Diamond. You have to send this message, Sunday Diamond. When you send this message, it will ask you whether you have enrolled in any of our earlier courses. It will ask you what is your background. Okay, you just have to comment these two. And let me also give you a link now. Let me also give you a link. Yeah, here is the link. Click this link, it will automatically generate a message called Sunday Diamond. Okay, send that message and wait for the crazy offer. Yes, I mean it. It's going to be really, really a crazy offer, which you can't even imagine, with Diamond membership. As I told you earlier, Diamond membership gives you access to what? It gives you access to 130 plus courses. It gives you access to 130 plus courses, gives you access to 100 plus ebooks, access to all the live classes we are going to conduct, access to all the future publications. Okay, so open your WhatsApp or click the link and send the generated message. It will generate a message called Sunday Diamond.